My first time home buyer masterclass. I call it a first time home buyer class. The truth is it is for anybody and everybody who's looking to buy a home. And really my goal is to walk you through what things you need to know through the home buying process. We're going to answer questions you didn't know you had, talk about what to expect and what things to watch out for as we go through the process. So let's go ahead and dive in. If you have any questions about anything as I am going through this, feel free to post in chat, and I'll cover comments periodically, and sometimes I'll cover it while we're in the middle of talking. All right, so let's go ahead and dive in. So let me get here. All right, so bear with me for 1 second. Perfect. All right, so the first thing is I got to move my silly little screen here so that it is not right there. Okay, perfect. So what do banks care about? When we're doing a loan for you, what are the things that we're looking for and what are the things that we care about? And there's really three keys or three things that we are worried about when we're qualifying you for a mortgage. Those three things, first and foremost, are cash. How much money you have in the bank for down payment, closing costs, and reserves. The second thing we care about is credit. How well you've paid your bills in the past, because that's the best indicator of how well you're going to pay them in the future. And the third thing we care about, wrong direction, is income, because no matter how good your down payment is, no matter how good your credit is, if you don't have enough money coming in the door to make the monthly payments, you're not going to succeed. So those are the three things we care about. And I'm really going to spend a good amount of time tonight diving into all three of those categories. And then we'll talk about the home buying process and the journey. And so let's get started. First of all, cash. It's broken up into three things: down payments, closing costs, and reserves. So as we talk through these things, let me first say your down payment, we're going to have a chart here in a minute that's going to talk about how much you need for down payment. Your down payment, there are minimum required amounts for down payments. Typically, if you're buying a home for you to live in, you can put as little as 0 to 3 or 5% down payment. If you're buying a home as a vacation home, you typically need about 10% down payment. And if you're buying a home as an investment property where you're not going to live there, you need 15 to 20% down on average. Closing costs come in lots of different categories. What I'll tell you, big picture about closing costs is the fees you're going to pay upfront. When you get your offer accepted, you're going to write a check for earnest money deposit to the seller. That money is held by the escrow company to make sure that in case you breach the contract, in case you cancel without having a valid reason, they can keep that money. You also then are going to pay for inspections. So you might get a home inspection, a pest inspection. You'll hear me talk multiple times tonight about using a real estate agent is critical as you're purchasing a home, and your real estate agent is going to guide you through what inspections you should order, and they'll help you order those. And then the final thing is the actual loan closing costs. Now, the only loan closing cost you're going to pay up front is the appraisal fee. The appraisals run between $500 and $700 on average, and that's going to get paid at the time you start the loan process. All the rest of the closing costs and the down payment you pay at the end once you go and meet with the notary and sign your final paperwork. So your closing costs are kind of broken up into multiple categories. I'll dive into in a couple of minutes some ideas of where those closing costs come from. But let's and then reserves is extra money left over after you purchase the home. Most loan programs don't require reserves. As a matter of fact, some of the fringe qualifications, like if you've got a really low credit score on FHA or VA, they're going to require reserves. Or on the opposite end of the extreme, if you are looking to buy a high-priced home and you're doing what's called a jumbo loan, that's when you're also going to require reserves. Jumbo loans are the category that requires the most reserves across all the different types of loan programs. All right, so let's talk about cash issues. The first issue with cash is what I call seasoning. You need to make sure that if you're looking to buy a home, that the money that you're using for down payment and closing costs has been in your bank account for at least 60 days, or you can prove it came from a valid source and it was not deposited in cash, which is kind of my second bullet point there, saying cash is a 4-letter word. Now, obviously I'm joking there saying that it's profane. It's not profanity, but it is really, really bad in the eyes of the bank. Why? Because we can't prove where it came from. If we can't prove, even if you took $5,000 out of the bank at one bank and then you walked across the street and you deposited the same $5,000 10 minutes later, the fact that it's cash makes it almost impossible for us to prove beyond your word that that's where the money came from. So as you're preparing to buy a home, my number one thought about money and funds is do not deposit cash. If you have cash, spend the cash for your normal expenses. Spend the cash to pay for groceries. Spend the cash to pay for gasoline. Don't use the cash to deposit into your bank. But by spending the cash, the money that came into your bank through your paycheck and normal sources stays there. That money's not spent. So that's what's critical about cash, is make sure that you spend the cash, don't deposit it. The documentation of moving money is critical. You need to make sure that you're aware of when money is needed and how we document it. So the last two bullet points kind of go together. When you are looking at your assets, when you're looking at your money, do not think you're going to make your life easier by moving all the money into one bank account. Because all that really is going to do is it's going to make you have to prove where all the bank accounts were that it came from and the transfer of the money into the account that it ended up in. And it becomes a bigger paperwork nightmare. If you have money spread across 4 different accounts, just get me the bank statements for those 4 different accounts. You can consolidate the money together into one account right before you wire it to title. That's fine. But don't move it before I verify where the money is at. It's kind of one of those, I remember taking my kids on field trips when they were in grade school, and you got a bunch of kindergartners running around. It's like, everybody freeze, stand where you're at so we can count you. Because if you keep moving, you have no idea if you've double counted somebody. The same thing about your cash, not your cash, your money in the bank. We've got to have a picture of a moment in time where we know exactly where your money is and how it got there. Once I've proven that, if you want to move the money around, that's fine. But that happens at the time when you're in escrow to buy a home. So don't think just because you gave me bank statements when you got pre-approved that I'm fine, because I need to re-verify everything. So the timing really matters, because we have to be able to get the money from you about 7 days before you're supposed to get your keys. So if you're selling stock, if you're moving money out around in different accounts, make sure you've got that planned, especially if you're pulling money from a retirement fund. It can take a week or 2 to get that money. So you want to start it as early as possible. Remember, if you have any questions, feel free to post them into the chat here and I'll answer them as we go. I want to make this as interactive and valuable as I possibly can. So let's talk about how much money do you actually need to buy a home and where does that money come from? So you need the minimum down payment depends on the loan program. You're looking at VA and USDA loans that require 0 down payment. Conventional loans, if you're a first-time home buyer, you can put as little as 3% down. If you're not a first-time home buyer, you have to put 5% down. And FHA, what's funny is everybody thinks FHA is only for first-time home buyers, but it's not. FHA requires only 3.5% down, and you can get an FHA loan even if you're not a first-time home buyer. You just can't have 2 FHA loans at a time. So if you get one, and then you want to keep that house and convert it to a rental and get another one, you can't do an FHA loan on the next home. So it's critical to understand that. Now, where can your money come from for the down payment? 3 places. It can come from your own money. It can come from gift funds. And then it can come from down payment assistance programs. I'm going to spend a minute, I'm going to spend a little bit of time talking about some new down payment assistance programs and some ways that we can help you out and some of the pros and cons of down payment assistance. But basically, that's the minimum down. If you're doing a jumbo loan, you need much larger down payments, and we'll talk more about that a little bit later. The next thing you have to worry about is closing costs. Now, there's a lot of pieces that go into closing costs, but you're looking at an average of $10,000 to $15,000. Now, some people used to say 3% of your purchase price is reasonable for closing costs. Well, I don't know that I agree with that. If you're buying a $1 million home, you should not pay $30,000 for closing costs. It's going to be closer to $15,000, maybe $18,000, but it's not going to be $30,000. But if you're buying a $300,000 home, well, I don't know if $9,000 or 3% of that is appropriate. It's probably going to be maybe a little bit higher than that. So I like to use a dollar amount. I like to say it's between $10,000 and $15,000. Lots of things go into closing costs. That is not my money. I wish it was, but that's money that pays for the appraiser, the title company. It pays for your first year's homeowners insurance and property taxes. So lots of things go into the closing costs. And who pays for the closing costs is really the same 3 ways you can pay for your down payment, plus 2 extra ways. And that is with a seller credit and with a lender credit. Now you might ask, why would the seller give me a credit? Well, the seller would give you a credit because, especially as we've been seeing in the last year, there have been fewer buyers wanting to buy homes and the sellers lost their upper hand. So if you've got a home that's been sitting on the market for a little while and that seller's about to lower their price, let's pretend it was listed for $600,000 and it's been sitting for 2 months. Well, the seller's likely getting pressure from their agent to lower the price in order to attract a buyer. If you came in and said, hey, I'll give you your full $600,000, but I want you to give me $15,000 towards your closing costs. Well, the seller was about to lower the price by 25 grand. So they're super happy to give you that $15,000 in closing costs. And that's another really important reason why you need to have a real estate agent on your side when you're negotiating to buy a home, because the realtor is going to help you read the mind of the other side. And if you work with the realtor that represents the seller, it's kind of like hiring an attorney to represent you, but also represents the guy that you're suing. You kind of got the same guy in the middle that's trying to negotiate both sides, and playing both sides never really works out for anybody. So the seller is more in a position to do that today. And I'll talk in a couple minutes about the market, but in general, the seller's more in a position to help with closing costs today than they have been in the last few years. The second option is lender credits. Now, why would a lender pay for your closing costs? The lender would pay for your closing costs because you're paying a higher interest rate than market. And we figure, man, I'll pay 2% towards your closing costs if you're going to pay me an extra 0.5% per year, because just in the first 4 years, I'll make up the money that I spent up front. I'm going to make that up in extra interest just in the first 4 years. In general, that's why lenders would do it. The problem is, in today's market, interest rates have gone up so much, there isn't any room to raise the rates anymore, especially because lenders are expecting that interest rates are going to come back down and people are going to refinance before the end of 4 years. So we're never going to recover our money, which is why in a lot of cases that you're paying points, you're paying more in fee in today's market to get a loan, because lenders make money only 2 ways. We make money in interest over the life of the loan or in fees up front. And the problem is most lenders, most economists don't expect rates to stay where they're at. We expect rates ultimately to move down in the next year or so. For that reason, we don't expect to make very much money in interest over the life of the loan. So a lot of the free loan options that you used to hear of, they really don't exist right now, because lenders are not expecting to make money on these loans for very long. So they want to collect their money more upfront in fees. Now let's compare that to 2 years ago. 2 years ago, we're in January of 2021 and the market is it's February actually, February 2021, and the market is super hot. What you've got is super low interest rates. Rates are at 2.5 to 2.9%. compared to today's rates that are 6 to 7%. And what you had is a dynamic where the sellers were not willing to give you credits for closing costs. Why? Because they had 10 people writing an offer on every one of their homes. But lenders were willing to, because lenders had super low rates that they knew, hey, if instead of giving you 2.5, I put you at 3.1, I'm going to make that extra money for a really long time, because rates aren't going to be this low anytime soon. So lenders had confidence that they could bump the rate and earn the interest that they needed to make back the money they paid up front. So it goes back and forth. It's a yin and a yang between, is it a market where a seller will give you credits or a market where a lender will give you credits? And we're more right now in the market where a lender is willing to give you credits. All right, excuse me, where a seller is willing to give you credits, not a lender. Again, you guys have any questions, feel free to post them. If you're watching this later recorded on YouTube, feel free to put comments into chat and I'll catch them later. So I want to transition now to down payment assistance programs, because I talked on the prior slide about the fact that you can use down payment assistance to pay for your upfront down payment, but you can also use it to pay for your closing costs. Now, there's lots of down payment assistance programs. Some of them are grants, some of them are loans, some of them you pay interest, and some of them you don't. But the fact is, none of them are free money. Even the new one that I'm about to talk about, which is going to sound like free money until we get to the end of it. So let me explain to you, this program's coming out in the next couple of months, and it's going to be from the state of California. And what it's going to do is it's going to let a first-time home buyer, by the way, the definition of first-time home buyer is somebody who has not owned their primary residence in the last 3 years. This new program is going to let a first-time home buyer get up to 20% of the purchase price of their home as assistance. That means that if you qualified for a $400,000 home and you said, gosh, I can't find anything in my neighborhood at $400,000, I really need to buy something closer to $490,000. Guess what? This program, you could buy a $500,000 home and they would give you a loan for the 20% of 500,000. They'd give you a $100,000 loan. You would only have a payment on the 400,000, which is what you qualified for originally. You get a higher priced home that gets you into the neighborhood that you want to get your family into. It gets you a better monthly payment because with that 20% down means you don't have to pay mortgage insurance. So you get to buy a home that's more expensive, not because you need a more expensive home, but because the price you qualified for, it just didn't work for your family. So this will let you get into home ownership. Now there's always a cost. In this case, the cost is not interest. There is zero interest charged on this program. You will not pay any interest on that $100,000. What you're going to pay is a percentage of how much your home value goes up at the time that you sell the home. Now, the details are not fully out on this program. And so I've already thought, well, what happens if I refinance? How do they determine how much the value of the home is and how much equity do I need to share? I don't know. I'm still learning the details, or we're still waiting for all the details. But here's what I do know that they've published. And by the way, they've said these rules are subject to change, but they're pretty sure this is what it's going to look like. And that is when you sell the home, you pay 20% of what the home value has appreciated. So what you look at is, hey, if the home value went up by $100,000, then you're going to pay $20,000 of the $100,000 increase in value because you got 20% of your purchase price in assistance. But here's the cool thing. If you want to get less assistance, if you don't need as much assistance, and you say, you know, John, 10% of the purchase price is enough for me, then you only pay 10% of the appreciation. So if you said, hey, I only need $50,000 in funds to buy this $500,000 home, then if that $500,000 home goes up to $600,000, you're only paying $10,000 of the $100,000 increase. Now you might say, man, John, that's crazy. Why would I want to pay $10,000 on a $50,000 loan? Well, here's the deal. You're actually a pretty low risk situation because if house prices don't go up, you pay nothing. So if you bought that $500,000 home in any other down payment assistance program, you're paying that money back with interest no matter how much the house went up. And you're only going to get a small amount of assistance. With this program, you get a large amount of assistance. And the truth is the average increase in home value per year is around 5%. So if your home value went up by 5%, then what you're really paying on that money is 20% of the 5% the house price has gone up. Well, that's 1% of the home price. So you're paying 1% per year in interest. That's a pretty darn good interest rate if you ask me. So there's a way to look at this that makes it a huge opportunity. Now, it's not for everybody. If you have the money for your own down payment, use it. This is not free money, but it gives you more opportunities. So when we're thinking about a masterclass and I'm trying to give really good advice on how to take advantage of the housing market and make it work for you, this is one of the ways to make that happen. All right, a little bit more on down payment assistance. We have other assistance programs that are out there right now. And a couple of highlights of them is we've got some special grant options for people that work in specific fields. So medical and healthcare workers, we've got special grants for you. Law enforcement, firefighters, people who work in education, we've got special grant programs for you. And there's even a grant program, and I have no idea how this list came about, but there's a grant program for people who are employees of the county in these specific counties. So you can look at this list real quick. It's all over the map of California. So your county may or may not be there, but if you happen to be an employee of one of these counties, if you happen to know somebody who's an employee of one of these counties, or if you happen to be a realtor and are looking to offer an amazing program to a specialized group of people, you can offer this special grant program to people who are employees of these counties. So some really good options to help people with down payment assistance. One more thing I'll throw out there really quick, and I don't have a slide for this, but there's actually an option, and my realtors who are watching will really love this. There's an option I just learned about where you can buy a multi-family property, meaning a duplex, a triplex, or a fourplex, and you can put as little as 5% down, and you can get assistance for the other 5%. So you can put 0 down on a 2, 3, or 4 unit property, as long as it's your primary residence and you're a first-time home buyer. That's huge. And the coolest thing for the realtors that are listening, it's a conventional loan. You know, it's not FHA. FHA has some funky rules for buying multi-unit properties with small down payments. This is a conventional loan with 5% down on a 2, 3, or 4 unit property, and you get to have down payment assistance on top of that. Really cool option for people who are looking at affordability and trying to figure out, how do I afford a home in today's market? That's a house hack that can help you afford a home in today's market. Even though you might not be able to afford the total monthly payment, you've got 1, 2, or 3 other families that are helping you to make your mortgage payment for you. All right. And Penny asked, first-time home buyer, meaning you haven't bought one in 3 years, meaning you haven't owned one in 3 years. So even if you bought it 10 years ago, if you owned it anytime in the last 3 years, you're not a first-time home buyer. You essentially have to have been a renter for the last 3 years in order to be considered a first-time home buyer. Hope that helps answer the question. If not, feel free to post in comments and I'll address it as you clarify. Okay, so credit. So we're done talking about cash. Now let's transition to talking about credit. There are really simple ways to look at credit. Credit is how well you've paid your bills in the past, and it determines your interest rate. Now, everybody says, well, no, John, I've got great income. I should get a low interest rate. Here's the deal. If you have great income and you don't have good credit, that's scarier than people who have low income and don't have good credit, because it means you have the money coming in, you're just not making wise choices with it. Now, I'm not passing judgment. I'm just telling you how the system looks at it. And if you are tight on income and you have bad credit, at least that's more understandable that there was a reason why you couldn't afford to pay your bills. But if you have great income and poor credit, you're not going to get a good interest rate. If you have low income and great credit, you're going to get a good interest rate. Income is literally a yes or no question. Either you make enough money or you don't. Credit is all about shades of gray. It's about, are you really good or really, really good or really, really, really good, or really bad or really, really, really bad. So credit is really about maximizing your credit score. Now, I can do a whole class. I can do a whole hour on credit. If you go to my YouTube channel, you can go to youtube.com/JohnLoanKing. And on my YouTube channel, you're going to see a lot of videos on there. And the one that I'm talking about, I did an hour-long class on credit and how to improve your credit, what things we look for in credit. But the bottom line is, do not take advice about credit unless that person has pulled your credit report and is running a simulator to help figure out what your credit is doing and how to best address it. Otherwise, it's kind of like taking medical advice by going on to WebMD, or worse yet, posting on Facebook saying, hey, anybody ever seen a picture of this thing? Because that's what's going on my back right now. What do you think I should do about it? I don't know about you, but that's not really the best advice on how to deal with some kind of a growth on your back. And it's certainly not good advice on how to deal with your credit. So don't listen to your friends when they say, oh man, I paid off all my bills, or oh man, I did something different to fix my credit. Because just like medicine, if you take somebody else's pills for high blood pressure, it might kill you, because those pills specifically were based upon their medical history, not yours. You take somebody else's advice on credit and what they did to fix their credit, it might ruin your credit, because that advice was based on their credit history, not yours. The other thing I want to say about credit is there's programs out there to fix your credit score for you. I'm not a huge fan of them. I think that here's the truth. They're not doing anything you can't do yourself. They're writing letters, disputing items. You can dispute them. The truth is you're simply saying, hey, it wasn't me. I have not seen a magic bullet anywhere that gets you from bad credit to good credit simply by writing a check to someone. I think there's a lot of options that say, hey, I personally can give you a simulator that breaks down what to do specifically to improve your credit score. But you got to do it yourself. Could you pay somebody else to do that and they can write the letters for you and they can call the creditors on your behalf? Yes, they can. But here's the thing that scares me the most, that I've seen more than a few times in the last year from my first-time homebuyer clients. And that is they get caught in the trap of thinking that the person who called, or the website or advertisement they saw that talks about eliminating your debt, is a good idea. The truth is, most of those programs that talk about eliminating your debt are literally telling you to stop making your payments to the credit card companies and instead pay them. And then in 6 months, when your credit card companies haven't been paid for 6 months, they have a bunch of your cash in their pocket that they can go to those creditors and negotiate smaller payments or settlements with them. It works, but it ruins your credit along the way, because you're not paying those bills during the time that you're paying this company. They're not taking your money and paying them monthly. They're taking your money and holding on to it. They keep a portion for themselves. They hold on to the rest to hold up and pay out those settlements once they get to the point that that creditor is bleeding, is screaming and saying, gosh, why haven't you paid me? And then they end up saying, well, okay, we owe you $10,000, but I got $2,000 right here if you want to take it. And they ultimately end up settling for a lower dollar amount, but your credit is ruined along the way. So be super careful about that. All right, so now let's talk about income. I want to put a little bit of time into understanding what we look at, because a lot of home buyers misunderstand this. First of all, your debt to income ratio has nothing to do with your credit score. Your credit score is not higher or lower because of your debt to income ratio. But effective next month, your interest rate's going to be higher if you have a higher debt ratio. Yes, you heard me correctly. Effective next month, if you have a high debt to income ratio, that's going to impact your interest rate on a conventional loan. That is new. It was just announced last month, and Fannie Mae and Freddie Mac are requiring higher interest rates to be charged when someone's debt ratio is over 40%. So that can make a really big difference that never used to matter. So what do we look for in income? If I oversimplify, we look backwards for 2 years and we look forward for 3. Now, what does that mean? It means that if your income is not stable, we're going to want to see a 2-year history to figure out what the averages are going to be. So if you are paid as a self-employed person and you file your taxes as owning your own business, well, there's not a lot of stability to that. You may have built a great business, but the truth is you can't control always your revenue or your expenses. We can't predict exactly what you're going to get paid next month. So we've got to look backwards 2 years. Sometimes we can shrink that down to 1 year. Same thing if you're paid by commission, if you're paid in bonuses, if you get paid overtime, we're going to want to see a 2-year history. Sometimes a 1-year history is enough, but typically we're looking backwards 2 years. But here's what people misunderstand. They misunderstand the fact that, well, John, I just got a pay raise. Can't you use my pay raise? Sure, I can. If you're a salaried employee, and you went from making $50,000 a year to $55,000 a year yesterday, you got that update or that pay raise, I can use it immediately because I can predict the future. I know you make $55,000 every year going forward. Now you're hopefully going to get more raises down the road, but they divide that 55,000 by 52 weeks and they pay you that amount of money every single week or every 2 weeks. If it's stable and predictable, I don't really care about the past. People freak out and they say, oh my gosh, John, I changed lines of work and I'm that's going to ruin my ability to buy a home. No, it's not. As long as your new line of work is stable and predictable, meaning you're paid an hourly wage, you're paid a salary, you work a set number of hours every week. I don't care how much money you made yesterday or last week. It's when your future income is variable that I really care about what you made over the last 2 years. So you're asking, well, John, what is the 3-year look forward? I can't guarantee that I'm going to have this same job or make the same amount of money 3 years from now. That's true. But if there's a reason for us to think it's going to end before 3 years, we can't count it. Now, what falls into that category? The simplest one is child support income. If you have a child that is 16 years old, most child support orders say that the child support is paid until the child is 18 or graduates college up until the age of 22, I think it is. So you might say, hey, John, my 16-year-old, I still have another 6 years left because they're going to go to college. But the truth is, you can't guarantee me they're going to go to college. They might not. And so the child support income won't be received guaranteed for 3 years. The only thing I can guarantee is they're going to get it until their 18th birthday. So if you have a child that you're receiving child support for, you need to buy the home and close escrow the day before their 18th birthday, not the day after, 15th birthday. Because once the child turns 15, then you're not going to receive their child support for 3 more years. Same thing holds true if you are receiving temporary income. Let's say that you are getting unemployment. Can I guarantee unemployment is going to last 3 years? Well, no, it's not. It's not expected to. Workers' comp is not expected to. Long-term disability is, but we have to look at what the duration is. If there's no stated end time, we're fine. But if there is a stated end time and that time is going to end within 3 years, then we can't use the income. Now, what I kind of already alluded to is that the income calculation is not as complicated as you think if you're a W-2 employee, but it's probably more challenging than you think if you own a business. It's one of the things that I really preach, especially this time of year. If you or anyone you know own a business and you're looking to buy a home this year or next year, get your taxes prepared by your tax person and do not file them. What you need to do is you need to send a copy of those taxes to me so that I can review them and give you advice. Because once you file them, that's the permanent record. Remember in grade school, we used to have a permanent record that used to scare us, right? Well, your permanent record for your taxes is the first filing you send to them. After that, you're allowed to amend, but we rarely believe you when you amend the tax returns. So if we're going to make some changes, we want to make those changes before we file the tax returns, not after. So just make sure that you're doing that and showing me your taxes. And don't get caught with the misunderstanding that just because you own the company, yet you pay yourself on a W-2, you're not a W-2 employee. If you own more than 25% of the business, you're a decision maker. You get to decide what your income is. Therefore, we don't trust what you put on your W-2. We have to compare that with what amount of profit is left over in each of the last 2 years to make sure that you're not paying yourself more than what the company actually makes in profit. All right. So let's talk about the property. Now, I know I said in the beginning that there's only 3 things we care about, which is cash, credit, and income. The truth is that there's 2 more things we care about, or 1 more thing we care about, which is the property. The reason I separate it is because cash, credit, and income, they play off each other. If you've got an issue in one of those categories and you're strong in the other 2, I can almost always find a way to get a loan done for you. If you're weak in 2 or you're weak in 3, we're probably going to have a game plan for how to get you qualified later. But right now, what I want to talk about is property. And a property does not negate none of the other things. If you're strong in cash, credit, and income, it doesn't make it easier for us to deal with property issues. The property issues have to work regardless of your cash, credit, and income. So what are property issues? Well, the first one is value. We're going to send an appraiser out to make sure you're not the only one crazy enough to spend that kind of money for this property. The truth is, we're worried that if you can't make your mortgage payment, we're going to have to sell the home. And if we have to sell the home, we want to make sure that somebody else is willing to pay this price also. And it wasn't only you, because that's the house you grew up in and you had to have it back and you're willing to pay anything to get it. Well, that means that if you can't make the payment, nobody else is willing to pay that much because nobody else grew up in that home. So value is critical. Now, if you're putting a big enough down payment, then you can certainly buy a home for more than it's worth. But I treat your loan to value ratio based on what the home value is in the eyes of the appraiser. So it's critical that you understand the home appraisal is an important part of the process. There's two parts to the home appraisal. There's value and there's condition. So the appraiser is going to go out and the appraiser is going to do a random sampling of the condition of the home. So that means that they're going to flip on a light switch and say, cool, electricity works. They're going to walk through and see that there's no broken glass, there's no health or safety issues, and that the property is fully functional. Okay, so that's the thing the appraiser is doing. The last thing about property that most first-time home buyers don't understand is the type of property matters. Now, what do I mean by property type? I'm referring to, is this a single family home or is it a multifamily 2, 3, or 4 unit property? But I'm also referring to, is this a manufactured home or is this a condominium? All of those things come into play. The rules for the bank, the rules for the mortgage industry are different based on what type of property it is. So when you get a pre-approval, that doesn't mean you can go buy a condo. It doesn't mean you can go buy a manufactured home. What it means is typically you're buying a single family residence unless you've talked to me and we've talked about a different type of property and made sure that you qualify for that property type. All right, so let's move on past property. Let's talk about so now that we've talked about what it takes to qualify for a mortgage, let's kind of sum it all up. Here's the deal. The mortgage world has been blamed for collapsing the global economy. We did things in the early 2000s that we never should have done, and we're paying our dues. The weight of the federal government came down on us, and now we've got to make it really clear that we're dotting every I and crossing every T throughout the entire loan process. So this process, I'd love to say, is super, super smooth. It's not. Buying a home is kind of like flying in an airplane. And if anybody's flown in an airplane, you know that you're going to hit turbulence. And when you hit turbulence, it's not the sign of a bad pilot. It's just a fact of being in the air. That's going to happen. The pilot's job is to look out for the turbulence and try and fly around it. But the truth is, they can't always do that. Because if you try too hard to fly around it, you're going to fly way too far and you're either going to be super, super late, or worse yet, you're going to run out of gas and crash. Neither of which are very good things. So sometimes the best way to deal with turbulence is to fly straight through it. And that's ultimately what we have to do in the home buying process. Is I'm not telling you it's going to be without turbulence. What I'm telling you is I'm going to tell you when to fasten your seatbelts. I'm going to make sure that you didn't just get delivered hot coffee and that you spill it on your lap when you hit the turbulence. And I'm going to make sure to guide you through the process. So I need you to trust me. But the most important piece I want you to take from that is you do have a choice of who your pilot is before you take off. So be careful. As you're out there looking around, there's lenders who are going to discount everything. The reason they're discounting everything is because they aren't really that good at what they're doing, and they don't have the ability to help you through those challenging times. And unfortunately, their plane crashes more often than it survives. So check the history of the loan officer you're talking to. You can go to the federal website through the NMLS, the National Mortgage Licensing System, and you can look up any loan officer in the country. It'll tell you who they work for. It'll tell you how long they've worked for that company and how long they've been in the industry. It's funny when you find the really cheap deals where somebody says, man, I'm giving these away for free. Well, the truth is that guy was a bartender 6 months ago, and he graduated from college 5 years ago and has been bartending ever since, and now finally decided and done 7 other jobs and finally decided to get in the mortgage industry. Is that the person you want to trust as the pilot to guide you through what is likely the single biggest financial transaction you'll ever do in your life? and think twice about it. So make sure you know who your pilot is and make sure your pilot is well prepared. All right, let's talk about the home buying process in general. So step one is getting pre-qualified. I hate that word because really pre-qualification, it's funny, some banks actually call this a pre-approval as well. But a pre-qualification is really you just saying, hey, Mr. Bank, I make this kind of money and I make, my credit is this good and I have this much for a down payment. And they say, okay, no problem. Here you go. I've blessed you. Here's your pre-approval letter. Here's your pre-qualification letter. What really matters is when we've looked at everything. So we need to verify everything up front. We need to look at your credit. We need to look at your income. We need to look at your assets. We need to make sure that you are fully qualified before you go out shopping for a home. At that point, you get to step number two. Step number two is you hire a real estate agent. Now, as a home buyer, you're not paying the realtor, the seller of the home is. But you still got to pick a realtor you trust, just like you got to pick a lender who's going to pilot that plane for you. The realtor is a co-pilot. Maybe the realtor is the pilot and I'm the co-pilot. I don't know. Penny, you can probably, Robbie, you can tell me what you guys think about that fact. But bottom line is we are co-pilots together in the process. And so you got to make sure you're picking the right person. One of the things I want to tell all first-time home buyers is about a little known legal term, teamwork, exactly, Penny, a little known legal term called procuring cause. The procuring cause is basically who was the person that was the cause of you procuring or buying this home. And that's the realtor who opened the door for you and showed you the home. Now, this doesn't count in an open house, but let me give you a scenario of what this looks like. It's a Sunday morning. You see a house that just came on the market last night, and you thought, man, my realtor is probably tired from a long day's work, and it's Super Bowl Sunday. I don't want to call them. I'm just going to call the realtor who represents the seller and have her open the house for me. And then I'll have my realtor write the offer on Monday. Guess what? Because you called that person and had them open the house, you've legally hired them as your realtor to represent you. Now, sometimes they'll let you out of it and they'll say, no, you can go ahead and work with your agent, but sometimes they won't. Do you really want to just cross your fingers and hope that that's going to happen? No. So make sure that when you go out looking for a home, that you're using your realtor, or if your realtor can't make it, you call your realtor, they'll find somebody that will open the home on their behalf. Once you find your new home and you get your offer accepted, that's the soonest we can lock in interest rates. Interest rates change on a daily basis. And until you get me a fully executed purchase contract, I cannot freeze your rate. They're going to go up. They're going to go down. I'm going to talk in a couple of minutes about the market, but I'll tell you, over the last couple of weeks, interest rates have been moving up and there's nothing we can do about it. It's no different than airline tickets or gas prices. You just kind of cross your fingers and hope that it's good at the time that you're ready to buy it, but you don't have a choice because it's a market that's fluctuating on a daily basis. Now, once you've got your contract, that's when we order the appraisal, we lock your interest rate, and we send your file to processing. The processor is the person that's the liaison to the underwriter. The underwriter is the final decision maker on your loan. That's the person who has the authority to say yes or no. It's at that stage that most people say, oh my gosh, the bank told me no at the end. Well, the sad thing about the industry, the mortgage world, is the person who actually has the authority to make the decision rarely sees your paperwork until the end. So you got to trust the pilot that you've got in the beginning, that they know their rules and they know the industry well enough that when they say you're fine, you're really fine. Otherwise, you might be crashing the plane at the end because you picked the wrong pilot at the beginning. Once your loan's approved by underwriting, that's when you sign papers with the notary, and that's when you bring your money in for the remainder of your down payment and your closing costs. And then you get to step 6, which is moving into your new home. All right, so let's move on now. Oh, can't get my screen to move on to talk about types of loans. Again, I'm covering a lot here because this is really my masterclass diving into how to buy a home and the things that you need to know. Now, there's really 3 major categories I want to point out when we talk about types of loans. And that is conventional, FHA or VA and USDA, and then jumbo loans. Give me one second. Talk amongst yourselves. I'm just kidding. Okay, so a conventional loan is a loan that's backed by Fannie Mae or Freddie Mac. You may have heard those names before. Fannie Mae and Freddie Mac are they're kind of government owned. Actually, they're very government owned right now. Companies that set the rules, they set the standard for what people need to meet in order to qualify for a mortgage. It's really about uniform guidelines so that the investor, Wall Street, can say, yeah, I know this person qualifies because Fannie Mae said that they met their rules. But Fannie Mae doesn't approve anything. Fannie Mae sets the rules. The lender and the underwriter is looking to confirm the loan meets Fannie Mae's rules. So Fannie Mae and Freddie Mac make up together what we call the umbrella of conventional loans. A conventional loan has a loan limit. You can only borrow up to a certain dollar amount. In 2023, that limit was increased to $726,000. And in some counties, you can go higher if they're high cost counties. So you've got the ability to buy a home, and you could buy a home for $1 million in the Bay Area, and you can do as little as 5% down payments, because that's a conventional loan in a high cost market like the Bay Area. Now, cash, credit, and income. Let's talk about those relative to these types of loans. Before I do that, let me explain. Conventional is the first category. The second category is what we call government loans. Those are loans that are actually insured by the federal government through the departments of FHA, or the Federal Housing Administration, VA, or the Veterans Administration, and USDA, yes, I said it, the United States Department of Agriculture. John, what the heck does the Department of Agriculture have to do with homes? USDA is created to help farmers get workers and get homes in rural communities where their farms are located. Now, there are actually rural communities right in our backyard. When we're outside of major metropolitan areas, that is considered a rural community. The whole Sierra foothills is all rural communities, even Galt. So if you're in the Central Valley, Galt is a rural community. Now, Galt's grown, but technically USDA is still basing their population on the census from 23 years ago, because they never updated it to the 2010 census, and they haven't updated it to the 2020 census. So they've frozen in their map, their territory, back in the 2000 census. And if your city was small enough at that time, you're considered a rural community. And Galt is an example of a rural community that's exploded in the last 23 years, but it still allows for USDA. The third category is jumbo loans. Those are private loans directly from a bank. They're institutional loans. The challenge with jumbo loans is it's the wild, wild west, because unlike conventional, where you have Fannie Mae and Freddie Mac setting the same rules for everybody, you've got every bank setting their own rules. So some are going to say, I can accept this, and others are going to say, I won't. Some are going to be happy with one thing and unhappy with another. So it's really about, when you're doing a jumbo loan, if you have great credit, great income, great assets, you can go anywhere you want. Every bank will beg you to give you their money. But if you're anything short of perfect in every one of those categories, you're going to be challenged, because most banks, they only have one jumbo loan product, and you may or may not fit their criteria, and you may actually get the wrong advice because you're working with a bank that doesn't have a product that suits your needs. We are not a bank that lends our own money. We don't have our own money to lend. So we have relationships with seven different banks that we can lend their money for jumbo loans. Now, if you have amazing, perfect down payment, perfect income, perfect credit, the truth is you're going to get the best deal by going to the big banks. But if you're anything short of that, if a big bank tells you no, I am your absolute next best stop for jumbo loans, because I have 7 different investors that I work with, and I can help navigate the waters to get you the best deal based upon your criteria. Having said all of that, what you're looking at is a conventional loan. Ideally, you want to have 10% down or better. Can you do it with 3 or 5%? Yes, but you're going to get the best terms with 10% down or better. Credit, you really want to have a 740 credit score or better. The minimum credit score for a conventional loan is 620, but unless you have a huge down payment, you're going to have a really hard time qualifying, and you have a super high interest rate, because conventional loans are very sensitive to your down payment and your credit score. If you have low credit and a low down payment, the interest rate on a conventional loan is going to be super high versus a government loan, your FHA, VA, and USDA loans, more forgiving, less concerned about, oh, you know what, your credit is good enough instead of, man, I need your credit to be perfect. So you can put 0 to 3.5% down. Anything greater than 640 is ideal. And I can go down to a 580 credit score in a lot of situations. And then debt to income ratio is just a guideline. That's the hardest one for people to understand and to calculate. So let me be your guide when it comes to debt to income ratio. All right. So having said that, let's cover some common questions. So one of the things that a lot of people ask is, how do I pick a realtor? Well, the same way that you pick your note. No, I'm just kidding. The best way to pick a realtor is by referral. It's really, really important that you work with a realtor that you trust. If you don't have a realtor that you trust, I can connect you with one. I know realtors up and down the states. I know some people that are really, really good at what they do. I've been doing this for 23 years, and I've seen different realtors, and they are not all created equal. So if you don't have somebody that you or your family members have worked with in the past, talk to me. I'll help get you connected with a great real estate agent. All right, the second question a lot of people ask, how soon should I get pre-approved? Well, what you shouldn't do is wait until the day you're ready to write an offer to get pre-approved, because you're gonna be hard pressed to get a pre-approval, especially a quality one, at the last minute. What you wanna do is you want to be prepared early in case there's anything about your cash, credit, or income that surprises you. You do not want to be in a situation where you know, hey, my lease is up in September, so I'm going to wait until July to have my credit pulled. I can do a soft credit pull, costs you nothing and doesn't show up as an inquiry on your credit report. And I can pull one of your credit reports as a soft pull now to get a sample, to get a little test of what your credit looks like, to see if there's any surprises. You do not want to be surprised 30 or 60 days or 30 minutes before you're trying to write an offer. You want time to fix what may be broken or to validate that nothing is broken at all. So you should absolutely look at getting your pre-approval done early. Even if you're saying you're not going to buy for a year, let's validate everything now. Because I've seen too many stories of people who are self-employed that thought that we looked at their top line revenue and not their bottom line profit, but the lender never asked them to look at their taxes. I have one lady who spent 3 years fixing her credit. And by the time she got her credit fixed, she said, you know, John, I've met you. I've gotten to know you. I'd actually rather work with you than the guy I've been talking to. Can you help me qualify? I said, yeah. I took a look. Her credit was great. She was super excited. And I asked her when she came in that day, hey, we're going to pull your credit, but I also want to look at your income. And she said, why? And I said, well, I want to make sure that we're on track. And she goes, oh, I make over $100,000 a year. And I said, okay, but I still want to look at it. Bring your taxes. And she did. So I pulled her credit, super excited. Credit's been repaired. I look at her taxes. It says she lost $1,000. And I said, I'm confused. You said that you made $100,000. She goes, I do. It's right there. It's on the top of the page. And I said, yeah, but you paid for contractors and you paid for rent and you paid for all of these other expenses. And it shows that you lost $1,000. She goes, John, that's not real. That's what my tax guy does to save me money in taxes. But I really made the $100,000. And I said, here's the problem. The problem is the money we're getting all comes from the federal government. And Uncle Sam does not want to loan you money when you're not paying him money. So we base our qualifications on the amount of money you pay taxes on. Now, there's some ways we can massage that. There's some differences of how we look at that, and we can add certain things back in. But the truth is, you don't want to be caught in that position. So you want to get qualified early to make sure that you don't have any problems. One of the most important questions I get asked is, hey, John, is now a good time to buy a home? Let me tell you, it is an amazing time to buy a home if you can afford the payments. Here's the deal. Interest rates have doubled. We were below 3% a year and a half ago. We're over 6% right now. Interest rates are ranging and they're going up and down. We hit the peak at 7.25% last October. And we've been coming down, and at the end of January, we were down to 5.9. But then in the last 2 weeks, rates have skyrocketed again. Now, skyrocketed may be an overestimation, but rates have moved up significantly. We're in the mid to high sixes. Now, everything's different for everybody. I'll cover in a couple minutes where interest rates are at or what factors go into interest rates. But the truth is, rates have moved up easily 0.5% in the last 2 weeks. Why? because of the economic data that's coming out. Nothing ever is the same. Nothing's ever a straight line, meaning that as house prices go up, you see dips, and then they go up and they dip and they go up and they dip and they go up. The same thing with interest rates, whether they're going up or down, you're going to see it up and then dip and then up and then dip. Whether it's on its way up or on its way down, you're going to see dips. Right now, the mortgage industry is trying to figure out what the Fed is going to do. And in the last 2 weeks, there's been lots of reports that came out that show the economy is super strong. Good news for the economy is bad news for the mortgage rates. So right now, we're in a little bit of an upward push. I don't expect us to get above the 7.25 we were back in October. I didn't expect us to go as high as we went back in October. But here's what I do think. I think that interest rates are going to be lower in the next 12 to 18 months. I think we're going to see interest rates getting back into the 4s in the next 12 to 18 months. But we have a small window right now. And over the last few weeks, I almost felt like that window had closed. It's not. And it's actually good news that interest rates are going back up a little bit. And you're going to say, John, that's crazy. What do you mean it's good news that interest rates are going back up? Because it's opening up opportunity. It's opening up opportunity for those of us that are willing to take a chance and buy while rates are a little bit higher, because it's causing house prices to go down. For the last year, we've been seeing house prices coming down as interest rates went up. And simple logic, simple supply and demand says as soon as interest rates come down, house prices are going back up. When exactly are interest rates going to come down is anybody's guess. But we saw them come down between November, December, and January. They dropped from 7.25 to 5.99. And at the end of January, we saw a lot of competition. I saw a lot of buyers competing for few homes, and we were seeing multiple offers. We were seeing bidding wars again that we hadn't seen in a year and a half or a year. We were seeing bidding wars. But the reason why is because rates had fallen, and it proved my point. As rates come down, even just to the 5.99, a lot of buyers jumped in. Well, now those buyers are jumping back out. And so it's opening up another opportunity, because you can buy a home now and you can refinance it later when interest rates come down, assuming you can afford the payments. That is the biggest #1 challenge that I tell people is, if you can't afford the payment, you're not going to succeed. You're going to lose the home to foreclosure. You're going to be completely stressed out trying to find a way to rob Peter to pay Paul to make the monthly payment. Don't do it. But if you can afford the payment, even if you need to stretch a little bit and stop putting money in your 401k, even if you need to stretch a little bit and stop saving as much money as you had been saving, the truth is, owning a home is a great investment, but you have to own the home in order to get the benefit of the investment. All right. So I think I've talked about most of this stuff, but I'll tell you that the interest rate absolutely determines your monthly payments. So as the home price, your home price is basically your down payment, and your monthly payment are what you can adjust when you say, hey, I want a lower monthly payment. You've got to either hope for a lower interest rate, or you need to lower your purchase price, or you need to increase your down payment. I already talked about inflation being what's really been causing the rate run up for the last year, and we're seeing inflation start to cool off and coming back down. So the question that I kind of answered, but I'll be more direct, is people say, should I wait for interest rates to drop? Hey, sure, no problem, except you're going to pay more for the home. And if you don't have a huge down payment, you're going to be hard pressed maybe to even get that offer accepted on a home, because there aren't enough homes for sale. And there's a bunch of buyers that want to buy them. They're just scared right now, or they can't buy right now. And you need to jump in when they aren't able to. So waiting for rates to drop to buy a home means you're going to pay a higher price for the home, and you may not even get the home because of the fact that there's going to be more competition. Now, I got people who are saying, John, I'm waiting for prices to drop. There's going to be a crash. I don't see it coming. The truth is, builders have not been building enough homes over the last 15 years. We have a shortage of homes compared to the number of people who want to own them. I've got another video on my YouTube channel that talks about this. It talks about the dynamics of what's called household formations. Household formation is when someone grows up and moves out of their house and occupies a new property without vacating their old one. So when my kids grow up and move out of the house, that's a household formed, because they're taking up a new home without vacating the home that I was in, because I'm still in it. My wife and I are still in it. So that's a household being formed. Household formations have been delayed or depressed over the last 10 years because millennials have said, home ownership, nah. I'd rather renting, nah. I'd rather stay in mom and dad's basement. So you've been delayed. You've had household formations have been delayed, and there's a lot of pent up demand. I was shocked at how many people were looking to buy a home and happy that interest rates had gotten back into the 5s. Imagine how many people are going to be super happy when they get back into the 4s. It's something called recency bias. So as you take this masterclass and you think about how do I master buying a home in today's market, part of it's psychology. It's understanding how you think and how other people think. And recency bias is a psychological term. What it says is we are most biased by that which has happened to us most recently. You're like, duh, John, that's kind of what the words mean. Well, yeah, most sayings are literally what they mean. But the fact is, what that means in the housing market is when interest rates were going up and we went from 3 to 4%, people started saying, oh man, 4% is really high because my buddy just got a house at 3%. When they went from 4 to 6, man, 6 is really high because my buddy just got a house at 4%. But when they went from 7.25 to 5.99, oh my gosh, 5.99 is great because my buddy just got a house for 7.25. Crazy. On the way up, 5.99 seems super high. On the way down, 5.99 seems pretty amazing. Okay. So it's funny. It reminds me of when I was a kid and we used to drive somewhere with the family and we'd be in anticipation to get there. The drive getting there took forever. It was the same distance as the drive home. But the drive getting there, you were anticipating it and you were super excited and you couldn't wait to get there. Are we there yet, Mom? Are we there yet? Are we there yet, Dad? Are we there yet? But on the way back, you're tired and you're bored and you're done and you're home just like that because there's no anticipation. So kind of the same thing, a little bit different, but thought I'd throw in a funny story. The fact of the matter is recency bias matters. And if you wait for prices to drop, they're not going to because there's too much demand on homes. The fact is there aren't going to be a bunch of sellers that are going to sell their homes willy-nilly because everybody who needs to sell a home ultimately needs to buy one. Most people who need to sell a home need to buy one. So you're not going to have like what we had in 2007, 8, and 9. That market crash was because the sellers didn't need to buy a new home because the sellers couldn't. They were foreclosed upon. So the bank was the seller and the bank just wanted to get rid of it. The bank didn't need to worry about, man, if I sell this one, I got to buy another one. The bank didn't want the home in the first place. So they had to sell it. That's what caused the market to crash. And the truth is the market had come right back to where it was within the next 7 years. So even the biggest crash we've seen in history of tracking housing prices recovered within 7 years. Are you going to catch the absolute bottom of the market? No, it's impossible to know we're at the bottom until we're past it. So don't try and time the market. It's about time in the market that matters. Now, this chart talks about the 30 factors that determine an accurate rate quote. My first one is wrong because it says above or below 647, 200. Well, the truth is that's for conventional loans, which now is $726,000. But why do I put this up here? Because there's a lot of things that determine your interest rate. And there's a new one that I want to talk about that I don't think is in here. And that is if you're a first-time home buyer. Why do you say that, John? Because up until last month, I had people ask me all the time, John, I want to get that better interest rate that comes with being a first-time home buyer. And I'd say, yeah, too bad there isn't one. The only benefit there was up until last month was I'm a first-time home buyer. That means that I get to have assistance for my down payment. Okay. Now, as of last month, if you are a first-time home buyer, having not owned a home in 3 years, you are doing a conventional loan and you make less than 100% of the median income in your county. Now, if you're in a high cost county, it's 120% of the median income. I can tell you what those limits are. I can show you how to look it up when we do our consultation. You can buy a home and you get better interest rates than if you were not a first-time home buyer. Now, it's kind of weird because if you're putting a huge down payment, you already get really good interest rates. So if you're a huge down payment and a first-time home buyer, you don't get better rates. You get the best rates out there if you're putting a huge down payment. But if you're putting a small down payment, you pay higher interest rates. But if you're a first-time home buyer making below that threshold, you get the best interest rates, just like we'd reserve for someone that had premier credit, with premier down payment, but with not so premier credit and not so premier down payment, you get the absolute best interest rate. So it's a new program that we're able to offer for first-time home buyers when you have great credit and a great down payment, you're getting the best deal anyway, so this doesn't help you. But if you have anything short of great credit and a great down payment, you get the same deal as that person who had great credit and a great down payment. It's a huge opportunity to help people because Fannie Mae and Freddie Mac are shifting their focus. They're shifting their focus away from helping people refinance homes and pull cash out, and they're raising the interest rates on those. But they're putting their focus on helping people become homeowners and helping first-time home buyers become homeowners, and they're lowering the interest rates on those. So I got to tell you, this reminds me a little bit of 2000 to 2005, where there was a huge focus on getting renters to turn into buyers, and it kind of backfired. So I like the idea of helping renters become home buyers, but not if we get to a point where we're helping people who don't have the financial wherewithal to maintain home ownership successfully. So I think there's a double-edged sword to all of this, but the fact is we want to take advantage of it and give you the best possible deal we can at any time. And this is one way that we're able to do that. All right. So things to be concerned about. I kind of already talked about job history. You don't really need to worry about that if you're stable income W-2 employee that earns a salary or a fixed hourly wage for full-time work. Your job history is less important. Mortgage insurance. Now, mortgage insurance is a great question that a lot of people misunderstand. So first of all, yes, if you put less than 20% down, you're paying mortgage insurance. But as a matter of fact, sometimes you're paying it even if you put more than 20% down, because FHA and USDA and VA require their version of mortgage insurance no matter how big your down payment is. Because they figure, look, if you qualify for a conventional loan, go do it. But if you're doing my loan, if you're doing an FHA, VA, or USDA loan, you're doing it because there's something about your qualifications that say you can't do one of the conventional loans. So you're paying mortgage insurance no matter what. But if you are doing a conventional loan with less than 20% down, you don't have to pay a monthly fee. You have two other options. You could pay it as part of a higher interest rate, which gives you a better tax write-off, or you can pay it as part of an upfront fee. So it becomes a one-time fee and you buy out of your mortgage insurance. It's kind of like paying for that get out of jail free card in Monopoly, right? You pay for your mortgage insurance one time and then you never have to worry about it again. Okay, so next issue, will a cosigner help? You know, the rules have been changing a lot. In the past, the only thing a cosigner would help with is income. So if you didn't have good enough cash or down payment, don't use a cosigner, just get a gift. If you didn't have good enough income, a cosigner absolutely can help, because I'll combine their income with yours, I'll combine their debt with yours, and put it all together and come up with one total debt to income ratio. And as long as that debt to income ratio works, you're good. But there's now an option for a cosigner to help you with credit scores. Conventional loans will allow me to average the credit score of your cosigners and of the person living in the house and the cosigner. So if you have a credit score of 500 and your cosigner has a credit score of 800, then the average is 650. So you qualify theoretically based on a 650 credit score. Now, the problem is your interest rate's based on being the worst possible borrower with a credit score below the minimum of 620. But if you're a first-time home buyer, you may qualify for that program that gives you the best interest rates, and we can put those two things together. So there's lots of ways to put this together. As long as you have the right pilot in your plane, we can help figure out how to put these pieces together to make it work for you. But I'll tell you, credit score, when people say how important is my credit score, it's critical. Credit score determines the loan program. It determines your interest rate. It determines so many things. Now, that doesn't mean if you have bad credit, you shouldn't buy, because it's about time in the market, not timing the market. But the fact is, you do need to think about your credit and make sure your credit is as good as it can possibly be at the time that you're purchasing a home, because it makes a very big difference in the loan program and in the interest rate. All right, as I wrap up, guys, remember, if you have any questions, please make sure to post them in chat. If you're watching this recorded, post them into YouTube chat or comments, and I'll reply to them later. I want to talk about the financial benefits of owning a home, because this is a masterclass and I want to give you the really good understanding so you're an expert next time that you're at a family party and somebody says, oh my gosh, home ownership is horrible because housing prices are going to drop. Well, you can explain to them that, well, that's only one of the 3 ways that you build wealth through home ownership, Uncle Bob. The other 2 ways are your tax write-off and your forced appreciation. So I think it's a good idea to own a home because I'm at least gaining in 2 of the 3 areas. And historically, that 3rd area recovers pretty quickly. And then guess what Uncle Bob does? He goes in the other room and he leaves you alone because he finally figured out that you're smarter than him. So let me explain to you how to tell Uncle Bob about the 3 ways to build wealth through home ownership. This is a simple example here based on a $350,000 purchase price. And what this example says is, look, you get a tax write-off that you need to talk to your tax preparer. Everybody's tax bracket is different, but you're paying $19,200 in interest based on, I don't know what interest rate this was on. I think it's somewhere on here, but I don't know. Anyway, I think it's a 6% interest rate. The bottom line is the interest is a tax write-off, and so is your property taxes. So you're saving $590 a month in taxes that you don't have to pay the IRS at the end of the year by being a homeowner. That's huge. The truth is that's even bigger than appreciation. I'll explain appreciation in a second. The second way you build wealth through homeownership is forced appreciation, or excuse me, forced savings. When you're a renter, 100% of your payment goes to the landlord. When you're a homeowner, a portion of your payment goes to the bank and interest, a portion goes towards property taxes, which are a write-off, the interest is as well. A portion goes to insurance, which you got to pay for insurance even if you're a renter. But the 4th portion of your payment is principal. That's money you are paying into your own pocket by building equity. You buy a $500,000 home and you put $50,000 down. So you borrow $450,000. Every single month, your $450,000 loan amount goes down. That means that your house, even if it never changed and stayed worth $500,000, as your balance goes down and in 30 years gets to 0, you have $500,000 of an asset, even if it didn't go up, because you're putting money into that savings account every single month because you're taking money and putting it into your equity. So for some people, that means that you really do just simply need to slow down your other investments. If you're putting money into your 401k and maxing it out, that's great. And I'll talk in a minute about why I think that's really, really good. But the fact is, if that's stopping you from becoming a homeowner, slow down your 401k investment. Stop putting money in your 401k until you get your next pay raise, but make sure that you have the money to pay to become a homeowner, because that forced savings account is your money. You're just putting it in a different way of investing. The 3rd way is appreciation. That's the way everybody thinks about, oh, home ownership, that's how you make money, is through appreciation. But let me explain to you how appreciation works. The average home in California is going up between 3 and 5% per year. But let's just assume it only goes up by 2%. That means that $350,000 home went up by $7,000 a year. Divide that by 12, that's $583 a month. That's amazing. You're actually getting almost $1,500 in monthly savings by owning a $350,000 home. You get none of that if you're renting. All right, so let's keep going here. Actually, before I move off of that, I want to talk really quick. There are 4 tiers of wealth building. I didn't realize I didn't have it in this slide deck, but I want to talk real quick about it. The first step to building wealth long-term is owning your primary home. I think it's critical for all the reasons we're talking about right here with the financial benefits. Now, the second important thing about building wealth long-term is to have a reserve account that has 6 months of your bills in savings. Now, sometimes when you buy a home, you've got to spend your savings to buy the home. Then your number one goal after you own the home is to build back up that account to get 6 months of your bills in a savings account. Then once you've done that, your 3rd step to wealth building long-term is to maximize your 401k, maximize your IRA, because that money grows tax-free. Every other investment you have, the IRS gets a piece of it. When you own a home, you get to have in growth. Right now, the rules are you as a single person, your house can grow by $250,000 and you share none of that with the IRS. As a married person, your house can grow by $500,000 if you're both on title, and you don't pay any of that to the IRS. But you also get a similar benefit through your 401k. You just don't get the other ones of these three. So your first focus is owning your primary home, then rebuild your reserve account, then maximize your 401k. Once you followed all three of those steps, then the fourth step is to begin investing in the stock market, bond market, wherever you want to invest, whether you use a financial planner or you decide on your own. It's a little bit of advice because the truth is I have found that as your mortgage guy, I'm often the closest to a financial planner you're ever going to get. And so I want to make sure that I give you that kind of advice to help you make smart financial decisions. All right, so as we wrap up, I want to go over a couple of things because who you choose to do your loan matters. Why does it matter? First of all, the reputation of that person in the marketplace. Because if you go with an online lender, the sellers and the real estate agents know that a lot of these online lenders, they don't double check anything, and the percentage of their loans that have challenges is pretty darn high. So the reputation of the person you pick to pilot your plane and to help you get qualified and get into your home matters. The pre-offer process. Whenever you write an offer, I call the listing agent and I sell the benefits of you, I sell the benefits of me and of your agent to make sure they know that we're going to communicate with them and take great care of them through the process. Now, why does that matter to you? Because if you've got two offers that are right next to each other, similar in price, similar in everything else, the reputation of the lender and the fact that I made those phone calls proactively tells the seller and the listing agent that let's pick this one because the communication is going to be better. The process is going to be better. Let's go with this offer, and it helps you get your offer accepted. The third thing is that when necessary, we can fully underwrite your loan. That means we can send your loan in for full credit, income, and asset underwriting. That makes your offer even stronger. That when necessary, we can do any one of the next two things. We can remove contingencies. And I think that's pretty scary to do. Scary might not be the right word. I don't think it's too high of a risk, especially in today's market, but there's times when that's necessary. And then the last thing is a quick close. I'll tell you a quick story. I got a phone call from a client on Tuesday, just 2 days ago on Valentine's Day, saying, hey, there was a realtor saying, hey, I've got a buyer and we're having problems with their loan. I need your help, John. Talked to the buyer Tuesday afternoon. We got all their information overnight. I talked to them yesterday, Wednesday morning. We locked in their interest rate. We've disclosed the loan. We've ordered the appraisal. We've already submitted the file to underwriting, and I have their loan approval today. Their closing disclosures going out tomorrow, and the appraisal's back on Tuesday. I'm going to have their loan documents to title by Thursday, and 1 week from tomorrow, literally 9 calendar days, one of which is a holiday next Monday, and they're going to be signing and getting their keys. So can I do a quick close? Absolutely. When necessary, we can get it done. So picking the right person to take care of you absolutely matters. And that's what I want to make sure that I'm doing for you. So gang, that wraps up everything that I wanted to cover today. If anybody has any questions about anything, please feel free to post those into chats. Otherwise, if you're ready to start the home buying process, you can pull out your phone right now and scan the QR code. And that'll get you set up with a questionnaire where we can get you going into the home buying process. You can go, you can email me. You can find me on all social media channels just by searching at John Loan King. So if you have any questions about anything at all, please feel free to reach out. This really is an exciting journey, but it's one that you have to make sure you make the right steps. And choosing the right person to go through this process, having the right information at the right time is critical in today's world. And I'm honored to have the opportunity to interview to be that person for you. So thank you again for your time today. As I'm talking, I don't see any comments or any questions in chat. So I'm going to go ahead and wrap this up. Thank you, Penny. I appreciate that. Thank you, everybody who made it live and everybody who's watching recorded. I appreciate you. Please feel free to reach out with any questions, and everybody have a wonderful evening. Thank you. Bye-bye.
Thanks, John. Super helpful.
You're welcome. See you later.